So one of the ramifications of central banks lowering yields across the globe is that investors that were typically sitting in cash or short-term fixed interest are moving into equities to find higher income. We think this is a risky proposition. The equities market is risky, and we're thinking in some situations we're seeing companies being purchased on the basis of yield with not a great regard for the underlying fundamentals of the company and the risks involved. Sometimes high yield is an extremely risky proposition. We're seeing a lot of yield exchange traded funds, income oriented funds, and obviously direct investors bid up the prices of what we consider pretty shaky companies because they've got high yields, and we think those yields in many cases are unsustainable, and when they're cut there'll be an issue. And I'll give you an example, and it was Metcash. Metcash had a very, very high dividend and dividend yield for many years. They were asked by investors to maintain their dividend at all costs, and that's exactly what they didn't need. Metcash was a business under pressure, an independent supermarket retailer under heavy competition. They needed to invest in their business to improve things. They didn't need to pay a dividend. So they cut their dividend, of course, over a period of 2 years. It went from 25 cents to zero, and of course the share price halved as a result. I mean, the income and exchange traded funds purportedly own nearly 10% of Metcash. They obviously sold as the dividend went. So the stock price went to $1. But the issue was the company had done the right thing for the company. They invested a lot of money in the business to improve their operations, and they've seen an improvement, and now the share price is $1.70. So it's a good example of a company that got bid up too high. They cut their dividend, and some of the value destruction was fair. They were under pressure, but the recovery that was there because they were able to retain cash in the business wasn't considered, and the guys the investors that bought the stock at $1 see it at $1.70 now. So it really gives a good example of how poor companies can be bid up, and when a dividend cut does occur, there can be an opportunity. I mean, we're not against yield investing and exchange traded funds. It creates great distortions in the market that we can exploit as fundamental investors, but we just caution other investors, don't invest on the basis of yield. Yield is the last thing you should look at. Look at the company first, the industry it operates in. Look at that first, work out the cash flows, and then just work out whether the yield is sustainable.